Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for this segment, we have Sylvia Jablonski, CEO and CIO of Defiance ETFs, to discuss how portfolios should be positioned in 2023 and beyond, and what sectors look most attractive. Sylvia, it's great to see you as always. Welcome back to Trade Talks.
Hi, Jill. Great to see you, and thanks for having me.
All right, and quickly, let's recap 2022. And then my question to you is, are we out of the woods yet for 2023?
Yeah, that's the question of 2023, right? So I think 2022 was just abysmal. I think it was a tough year for most investors. I think it's sort of it was the wealth crusher for a lot of people, but on the upside, I think it was also towards the end of the year anyway, a great opportunity to gather assets for younger people, people with long-term retirement outlooks and things like that. There's definitely some value creation that happens on these dips. In terms of 2023, are we out of the woods? We're out of the woods if the Fed kind of takes the foot off the gas pedal. So if Fed Chair Powell kind of does the next two expected hikes or so and hangs out there for the rest of the year and then talks about perhaps, pulling back, I think that would be a positive momentum for markets. But I think that, the caveat to how markets will react this year is what happens with the Fed. If the Fed keeps going higher for longer and goes above 5.1%, I think that'll be really negative for the markets. And until we get some certainty around that, we'll have this, kind of sideways movement. It's a great start to the year, though. So that's promising. CPI numbers promising and all that. So the data says that we should have a good year, but I think a lot of it depends on the Fed.
Right, and of course, perhaps this year will shift from the macro to fundamental. And in your notes here, it's saying that corporations look like they're in pretty decent shape as we head into this earnings season. What are your thoughts around that?
Yeah, I think this earnings season is going to be key in terms of just the general attitude and direction of the markets for the year. If, for example, we come out and we get a really strong earnings season, I think that would be great for markets, and that would tell us that perhaps a lot of the pain and perhaps the lows have been experienced. But if earnings are as bad or worse than expected, there's debate about whether analysts have come down enough. If they haven't come down and we do see that 10-20% earnings decline, I think that'll be a really rough run for the market. So earnings are key. My thought on this is, a lot of these companies, a lot of the major corporations that we look to when we think about earnings have cut staff. They've done massive layoffs. They've cut costs. They've become more efficient in their inventories, and that takes time to play out. I think that they've done that for the last 2 quarters or so. Some of them are doing that right now. So we'll have to see if that's enough to essentially impact their stock price and their earnings outlook and their margins and things like that. But just holistically, I mean, companies have strong balance sheets. They're in the game. They've maintained pricing power. So a lot of the Fed work has not actually, impacted their top and bottom lines just yet.
Right, and to your point earlier, this is a great opportunity for valuation creation, and tech sector, big tech looks pretty attractive here in 2023. And you have some notes here that while it has suffered, there are some attractive things happening within the space.
Yeah, I continue to love tech, and I've sounded like the broken record because last year the biggest tech companies were hit anywhere from 25% in the case of Apple to 50, 60% across the board, depending, if you look at Amazon and companies like that. But I think that, the next 5 to 10 years fully depends on tech, right? We have this massive growth in cybersecurity, massive growth in cloud needs. We need to think about deglobalization, what that's going to look like. Are we going to replace people with some AI in some cases to help manage these factories that can't run efficiently because of the shortage of workers? Is it a strong labor market a consequence of not having the right types of workers? And technology resolves a lot of those problems. It also makes things like electric vehicles, artificial intelligence, all of these things that we're sort of banking on to increase our GDP and grow as an economy and as a society, they all depend on tech. So I think that tech comes back. Also, just on another level, supply chain issues have been fixed. China's reopened. They're a huge consumer of tech. So I do think that tech has been badly beaten. And if you have an outlook beyond 2024, so let's say, forget this year. I don't know if you're going to make that 10-20% this year on Amazon and Apple and whatnot, but I think you're going to get that in the next couple of years. And so why not buy it while it's down and out?
Yeah, and travel stocks, if we switch to services here, Sylvia, I cannot recall, even prior to the pandemic, hotels, particularly in Vegas, or flights being as packed. No seats available as they have been now. And then, of course, you have China reopening. Think about all that travel demand that's been pent up.
Yeah, absolutely. I'm with you on this one. I think that, it's nearly the cost of a flight to Florida is the same as it was to, Paris now. If you're, living in the New York area. And I think that, there is so much pent-up demand for travel. Business travel is coming back online. We're still at that 70-80% number pre-pandemic. So you've got room to grow domestically. And to your point, we have China reopening, and China reopened with a real crash, right? So a lot of people have COVID in China now. They're not getting on planes. They're not able to go anywhere. So, once we kind of like shake that out and China actually has a proper reopening, I think you're going to see airlines. I think you're going to see hotels. I think you're going to see cruises just absolutely take off, particularly with, the world's second largest economy coming back online. Not only that, if you look at the inflation numbers, some of the data still does sit in those areas in the services sector, and airline tickets and whatnot. They've come down a little, but these companies have pricing power, and the CEOs of almost every airline have come on and said that, hey, forward looking demand looks really great. The cost of fuel has come down. Our margins are going to look better. So I think, like, air traffic control issues aside, Southwest technology aside, some of these companies can do really great. And I think looking at travel ETFs might be interesting for investors.
And finally, defensive names. Of course, you want to be in a sector like healthcare as we go through the first half of 2023, but then also the growth potential there with what's happening with health tech is pretty exciting.
Yeah, I think the growth in health tech is going to be massive. I also think that the macro story there just fits well. Well, first of all, these companies are just sort of, stable, right? Strong balance sheets. People keep up with their medical care regardless of a recession for the most part. You have this massive aging baby boomer population that is a consumer of health services, med tech, pharmaceuticals, and whatnot. Whether or not we're sort of past COVID, new variants are coming into play every day, and these companies are really benefiting from that. RSV vaccines, cancer research, all of this stuff is back online. So, and if you're looking for defensive plays that pay you a dividend along the way, tech is a good place to be. Health care is a
Yeah,
good place to be.
it certainly is. We appreciate the insight as always, Sylvia. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.